This chart shows total market cap 2, the crypto market excluding Bitcoin, breaking out of a massive cup-and-handle accumulation zone. Simultaneously, Bitcoin dominance flattens. When these cross, it signals alt season. Liquidity leaves Bitcoin, flooding into alternative tokens. This creates an immediate trade-off. You have a shrinking window right now to make your allocation decisions before retail hype takes over and prices become completely irrational. But reading the macro signals accurately won't help you if you deploy your capital into the wrong narrative at the wrong time. Right now, 62% of narrative interest is locked onto AI crypto. Treating that sector as a single uniform asset class is a massive mistake. The current hype cycle provides the perfect cover for standard meme coins to slap an AI label on their website and masquerade as technological innovation. Take Mile Moneda, for example. The token is entirely driven by the political and economic brand of Argentine President Javier Milei. There is zero underlying artificial intelligence technology driving the project. Compare that to massive multi-billion-dollar decentralized networks that are actively providing physical computing power to global machines. Buying blindly into the AI crypto buzzword exposes your portfolio to catastrophic risk. A global computing network and a meme coin have entirely different survival rates when the market turns. The foundation of this entire sector is the infrastructure layer, decentralized GPU marketplaces like Render, Akash, and Aether. The business model here is straightforward. Startups need massive computing power for AI training and inference, and they rent enterprise-grade GPUs directly from these distributed networks. These networks generate real revenue based on actual utilization and hardware supply and demand, rather than social sentiment on Twitter. The trade-off is pace. Because the token price is anchored to physical usage and enterprise adoption, you have to accept slower, cyclical growth. The infrastructure layer gives you the highest probability of long-term stability, but it forces you to sacrifice the overnight volatility that creates sudden, massive returns. If you want that explosive narrative core in 2026, you must look at autonomous AI agents like AI XBT and launchpads like Virtuals and A16Z. This diagram illustrates an autonomous AI agent, an on-chain entity executing independent financial decisions. Its token price is driven entirely by social influence and trading success. But this creates extreme operational vulnerabilities, leaving agents highly susceptible to targeted prompt injection hacks. There is also a severe centralization risk. Most of these agents run on traditional cloud servers. If that central host goes down, the agent ceases to exist. Investing in AI agents gives you hyper-direct exposure to retail hype, but you must accept a high probability of total capital loss if that narrative dies. Another speculative strategy is hunting for sub-$50 million market cap projects, like Neural AI or Paytex, aiming to secure a major Binance listing. To even be considered by top exchanges, these projects have to prove organic user growth and establish a clear product-market fit. The trade-off here is brutal. You are locking capital into highly illiquid assets that face massive early investor unlock pressure. If the exchange rejects the listing, the token price collapses. And before you allocate anything, we need to clarify a major point of market confusion: the difference between an autonomous AI agent and an AI trading bot. An AI crypto trading bot, like AllTradey, is completely different. It simply executes predefined strategies that you authorize, using your own exchange APIs. A trading bot is a tool to manage risk, not an asset for narrative exposure. Confusing the two will create dangerous, false expectations of your potential returns. This chart shows the infrastructure investor profile. It's a portfolio allocated 100% to major players like Render, Akash, and BitTensor. This approach insulates you from meme coin hype, but the severe trade-off is that you will underperform the broader market during peak retail mania. On the opposite end, we have the narrative speculator. This profile is heavily allocated to new Virtuals agents and sub-$30 million low caps. This maximizes your potential for asymmetric gains, but it requires intensive daily management and virtually guarantees massive 60 to 80% drawdowns when the cycle shifts. Neither extreme is ideal for the average strategic investor trying to survive the alt season with their capital intact. Instead, look at this chart representing the strategic optimizer framework. It balances your exposure: 50% in core large caps and launch pads like BitTensor and Virtuals, 20% in baseline compute infrastructure like Render and Akash, and 30% left over for speculative agents. This barbell strategy successfully captures the structural demand for AI enterprise computing while still maintaining upside for fast-moving narrative runners. The final trade-off is that this specific portfolio requires active rebalancing. You have to take profits regularly to prevent the speculative wins from overwhelming the stability of your core infrastructure. True crypto optimization isn't about finding the perfect token. It is about deliberately matching the volatility of the asset class to the reality of your personal risk tolerance.